Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back to another episode of Rebel Wisdom. I'm Julian here with my co-host B, and today we're gonna dive into some finances. Again, not certified experts here, just two guys that like money and like to talk about a lot of different things. So today we are going to be talking about mortgages and specifically the debt associated with it. You know, owning property or owning real estate, house, etc., versus investing, which can come in many different forms as well. So we'll keep it vague first, and we'll probably let that guide us through the conversation. But, you know, mortgage debt versus investing. And we're going to kind of dissect, our opinions on that topic or what we think, maybe pros leaning towards one way or the other. And we'll go through it. How's that sound, B?
Yeah, works. Well, this sounds good to me. I got the numbers
Cool.
prepped.
Yes, sir. Yes, sir. Big numbers guy. All right. In true Rebel fashion, just kind of giving some background on us for those that may not really know too much about us or those that do. We both dabble in the real estate space, and you more than I. And we also both dabble in investments as well. So, this topic for us hits close to home, some stuff we like to talk about. And without getting, I guess, too deep into our personal finances, right? Like, I think it's safe to say we both have real estate debt. And so more specifically for the real estate, and again, we both like to invest. So I guess I'll just give like quick background. I think I got into like real estate like 2020. I think 2021. I think I got my first of two properties, and which that really doesn't matter. I mean, I guess if you're like looking at the economy, like trying to do the math on like what was going on then, but more so, I think what age, because in both investing, real estate, I guess there's a form of investing, anything in this space, I think we would both agree that a huge piece is, if you can, and we're blessed to be able to be in the position to kind of get some properties. But I think regardless of what the year was, like, what age or like how young someone can start. So again, if somebody's on the fence, like I can speak for both of us when I would say, you have the opportunity, dive into it, because starting, the quicker you start, the better. So yeah, that would have put me in like mid to late, so I guess mid 20s, kind of like when I got started. And investing was probably a year or two or three before that. So kind of got into the investing a little bit, largely through you, honestly, and then a little after got into some real estate stuff. And I'm just as excited and would advocate for it now, as I did then. I think both are very advantageous to anybody, right? This doesn't. I'm not rich by any means. I don't think you have to. If that is a misconception that's floating out there, this is not a rich person's game. All you need is a little bit of like determination and capital, and you can certainly start investing. Real estate might be a little different game, but those are just kind of like my entering thoughts on the topic and some little background on me. What you got on your MB?
And so we covered the topic earlier in a different episode, on an earlier episode. Which one is better, like stock investing or real estate? And the conversation surrounding around that was, do you just rent and invest in the stock market for the difference, or do you buy?
Right.
And, we walk through different scenarios. And this one is a little different because in both scenarios, we're going to be talking about the person that we're highlighting, I guess, right? This fake imaginary person in both scenarios already bought the house. And the question becomes, do you add additional payments into your mortgage so you can pay down your mortgage faster to get to $0 in real estate mortgage debt, and then you start investing? Or do you pay the minimum amount of mortgage, principal, interest, taxes, and insurance, obviously, and with that, you could invest the difference, let's say the additional payments that would have been made in the first scenario, into stocks and then see who comes out on top. And
Yeah.
I see both. Like I really do see both positives and the negatives for both scenarios, and I think it's good because we say this probably like every 2 or 3 episodes. So many financial gurus, I believe some are just there to make money for themselves, but a lot of the famous like popular ones, I think they truly believe in what they try to teach, and I think it's better to follow a strategy than no strategy. And for example, like the big notable figures around real estate, debt, stocks, like you could like Dave Ramsey came up to my mind initially because
Yeah.
he's so anti-debt. And he would
Yeah.
say, "Hey, pay off your mortgage first."
Pay off the house. Yeah.
But we look at the other side of other people talking about it, and there's compelling arguments on not paying off your mortgage first and just stay invested. So that's the kind of topic that I want to kind of navigate around because I think it is I do see this topic being talked about in person and also in certain communities online. And it's like a big topic. And I think even myself, I have wrestled with this concept for literally 5+ years. So like, which one is better?
Yeah.
Which one is better? And then just want to kind of shed some light on that, I guess.
That's awesome. And this is one of those, I won't say rare cases, but cases where I think it's like either one is good. Like if you choose either one, it's good. But I think depending on your personal situation, one option could be better than the other, i.e., like investing could be better, like statistically, or or vice versa. But it's like if you did one versus the other, like it's not bad. Like it's not a bad thing to pay down your mortgage or eliminate
Yeah.
that debt, right? So that's why I think this is unique. All right, question to kind of pop it off. If you were, again, this is purely hypothetical because, I mean, we can't sum this up right here. But if you were to ask just your average American, you're walking down the street, right? You go up to somebody that is a homeowner and you said, hey, dude or girl, if you had the option right now to pay, I don't know, do we want to say, I guess we can't say pay off your debt, pay down your mortgage? I'm trying to be specific with my phrasing. May I add an extra payment to your mortgage? I don't know how you want to phrase it. Like pay, I know you know what I'm trying to say, but I'm trying to articulate it for
If
the
you got
platform.
like
But like pay down your
100K
mortgage.
and the only two options you had was to pay down your mortgage by 100K or stick the 100K into
Yes.
stocks with no tax implications,
Yes.
which one would you choose?
There we
type
go.
of thing.
Yes. Perfect. What do you think just the average part, like, or most people would do?
This average thing is so hard for me.
It's
I feel
hard.
like
Yeah. It's just your opinion. Like it doesn't. Yeah.
yeah, I feel like I'm detached from reality. Feel like because my group of friends that I hang out with and talk about these
Yeah.
stuff would all say one thing, but I'm trying to think about it from just a general average human behavior.
Yeah.
And I would say they would prefer to have the mortgage being paid down by 100K because of loss aversion from thinking fast and slow. Is that the book by Daniel Kahneman?
Yeah. I know exactly what you're
Thinking
talking about.
fast and slow. But basically, loss aversion is if you were to lose $5 versus gain $5, you would probably think that like your sadness level and your happiness level from those should be equal. But actually, when you lose money, the sadness level of losing money is greater than the happiness level of the gain. So therefore, I would think that based on average human behavior, they would want to pay down the loan. But it's hard because I don't know if the average homeowner is the average population.
That's good too, because I'm thinking, right, like within that pool, you're gonna have a lot of older people, right? And we'll say average person. This is we'll say 18 and up, like average adult, or even 21 and up, whatever. But even of that, like you're gonna have a large portion of that population homeowners be old, and you have to think of what their life structure is like. Like they're far less worried about growing money in the stock market because they're on the back end of life, whereas they could eliminate a payment and just have, they're probably on fixed income. So if they can just eliminate a payment and then have more for their everyday life, vice trying to gamble or put it in a long-term vehicle when they might not have long-term, as sad as that sounds, but you know what I mean? Like, yeah, they would probably choose pay down that mortgage. And they're definitely lumped in the average quote unquote person in this scenario. So you're right. There's so many factors, but I would agree. I think just somebody walking down the sidewalk that, homeowner would pick probably to pay down the mortgage. I think. Could be way off. I don't know.
I
But
don't
yeah,
think
but
I think we're right. I have a guess that is the right sentiment of how people would react. But again,
right? Like I see, yeah, we don't know because we're not connecting the experiment. But that's where it gets juicy, and it's like, okay, well, let's see what I mean. The best we can. There's so many factors at play, but like, what does it look like if we actually dissect that? Like, what would I'm not saying we have the answers now, but like, what would be the benefits of paying there? Or better question, in what situations would someone,
Mhm.
pay down? I don't know. We can explore that a little bit.
Yeah, can I walk through the numbers? I don't want
You
to
said
take
you got the
too
numbers, so
long because
yes.
okay. I want to share my screen so I can walk through
Yeah.
this. Can you see my screen?
Yes, I see the beautiful fish.
Okay, cool. Do you see my other screen now?
Oh yeah, the good old calculator.
Okay. We have two scenarios, like I said. In both scenarios, the person bought the house already. And here is the numbers that I used for the mortgage calculator. And you got to stick with me on the numbers, right? But please let me know if you think I made a calculation mistake rather than some assumption
Okay.
mistake. Because assumptions could be different for literally everyone.
Yeah. Yeah.
In my area, and from what I read on Reddit, I feel like the median home prices is around close enough to 500K. I think that
Sure.
national
Yeah.
average is like 430 or 450 or something like that, right?
Okay.
But I think 500. That's the number that I used. And in this scenario, I don't typically like putting down as an assumption of 20% because I think the more popular products are either like 5% down or like 10% down. That's like more
10%. Yeah.
Yeah,
I
I
agree.
think that's more realistic, but traditionally speaking, 20 is like the recommended value because it gets and it works for me in my assumption because it cuts off a variable which is a PMI. So if you have less than 20%, you
Yeah.
have to get PMI. And if you don't, if you pay the down payment and you have more than 20% equity,
Nice.
then you don't have to. So that's
Right.
helps me in my assumption.
Okay, that's fair. Yep.
And I used 30 years as a loan term because like a majority of the people are going 30
That's standard.
years. And I used 5.5% interest, which is I was trying to think of like a very fair number. And in today's market, what are we, like almost end of July in 2025, like you're not going to get 5.5% unless you have like a special, like a builder incentive loan that you can, you might, I've seen like 3-4% floating around there, but that's like on certain programs, right? You
Right.
could buy down the rate to 5.5%, but like not a
Sure.
lot of people are paying such a great amount to go from 7% to 5.5% off a loan buy down. So that's probably not realistic, but I do want to, because in this scenario, the person already bought the home. In the last 5 years, you got to realize we were coming in from like 2 to 3% interest, and now we're at 7. So
7.
some
Up to 7.
people have, I don't want to say some people, actually probably majority of homeowners today bought within the past 5 years or earlier, so they would have like a interest rate lower than 5.5. But
This lady
if
I
you
work
buy
with quit. We were talking the other day at work, has 2%. Like, and she's like,
Yep.
I'm never gonna see that again. Like,
right, which
insane.
I think we will see that again personally, but I see what they're, yeah.
Maybe.
But so I think 5.5 was a fair number that in my head that I could use. Today is about like mid 6, maybe like 7s if you have like bad credit or not, you're not the prime optimal customer or borrower, I guess. And whereas, people in the past 2, 3, 4%. So that was just kind of in the middle, right? And then I have a property that I bought for 525, and I just used property tax and home insurance numbers from that property.
Okay, yeah.
So that's the numbers where I got it. And obviously that's another one of the factors that's going to depend on the area that you live in.
Where you're
Right.
at, yeah.
Yeah. So that's the assumption. Bear with me on the assumption, but let's just go into the numbers, right?
Fair.
The most important figure here is the monthly payment is $25.26 a month. So we'll call it $2,500 just for easy numbers, right? And here is scenario A, where so this person buys the house, right? And we'll be looking at the 30 years like time frame, and I use 10% return because that is the average that the S&P returned over 10 years, which is a little bit higher than 10, over 30 years, which is like 9.9, which is like really close to 10, and over like 50 years is like 10.2. 10% is a really good measure for the S&P 500 in particular, looking at average growth rate. So that's why the 10% is there. So I'm going to stick to it in both scenarios. So in this case, you can kind of imagine the homeowner is paying the minimum PITI, which is principal interest, taxes, and insurance of $25.26, and we said it's going to be $2,500 a month. And let's say this person in both scenarios has $1,000 of additional income, disposable income that they can put towards the mortgage or in the stock market. In this case, it's going to be the stock market with $1,000 added to your portfolio every month starting at zero and 10% return. You're going to get $2 million after 30 years. So that's person A. And you also got to figure out your like house value in this equation, right? And I'm not necessarily a fan of using your primary home's equity into your net worth calculations because like you can't use the equity into a mate of your house towards financial gain, if that makes sense. Right? Because like regardless if you have 0% down or you paid a house in full, the value of the house is the value of the house. It doesn't go up or down based on what you bought it for. But over time, regardless of how you bought it, it's going to keep growing at a percentage base, right? But until you sell or take out a HELOC or a refi or something like that we're not considering in this equation, like you can't really use that trapped equity into that home. So I don't really like it, but this is for comparison purposes, right? So I said the house that you bought for $500K after 30 years growing at 5% annualized basis, that's going to be $2.1 million. So the person A, you would have a stock portfolio of $2 million and your house is valued at $2.1 million and it's after 30 years. So we can assume the mortgage is paid off at this point. So if you add those two, it's $4.16 million in person A.
Yeah.
So let's go to the second example, which same thing. They bought the same exact house, but this person decided to pay off his mortgage first before he did any sort of investing. So the original loan amount is $500,000 and the term is 30 years and 5.5%. How long is the loan for? We still have 30 years on it. Let's just say they just closed on the house yesterday. Yeah. So I have repayment with extra payments of $1,000 a month, which in the previous scenario, it went into stock market. But in this scenario, it's going to go towards paying down your mortgage. And then when you do that, you find out that you actually pay off your mortgage that was for 30 years in 16 years and 7 months. So you're paying it off 13 years and 5 months earlier, right? So at that point, the person B in this scenario would start investing in the stock market because mortgage is paid off, right? So that's where I try to depict here. You have a starting stock value of $0, and then it was 13 years and 5 months.
So for 13 years, you put
which is not exactly 13.5 years, but that was the closest.
It's 1 month.
Right. So that was the closest number. and then the annualized compounded rate for the stocks is still the same at 10%. And I put the extra $1,000 that person A was putting in, and as well as the 2,500 mortgage, this the person B doesn't have to pay anymore with the additional 1,000. So the total monthly contribution is 3,500.
Okay, good cat. Yeah,
right.
I didn't think about that.
So when you do that calculation, you get $1.15 million in the stock market. And in this scenario as well, the house is paid off and it has been growing at the same rate as person A for 30 years. So you get the same real estate value, which is 2.16, and added with 1.15. So what is that?
3.2?
3.31? Right, $3.31 million.
What was the other one? Yeah, something. Yeah, 3.3.
Okay. Yeah, 3.3-ish.
3.3, 3.2. Yeah.
So in person A scenario, they got 4.1 million.
Yeah.
And then person B was 3.3. This is the learning point. Or in both scenarios, right? Like one is clearly better than the other by 800K ish. But I do want to emphasize either scenario you follow, you're going to be good. It just
you're right.
So I do want to say that because we're kind of talking about we're not talking about, if that 800K mark is going to be the line between life or death. It's not really like that. The 800K difference is just like an added bonus, honestly, if you think about it. We said earlier, regardless of what strategy or who you follow, you're going to be okay, but we're just kind of talking about the nuances of what people talk about in the financial space. So clearly in this scenario, person A has a better net worth after 30 years and person B doesn't. So I guess I'll leave it off there. What's your thoughts around the numbers?
Once again, good, great breakdown. I'm glad you added the recouped monthly payment. As I was just kind of thinking through it when you were going, the monthly payment of person B to the $1,000 that they had for the 3,500. I think I would have missed that. But like you said, right? Super average, kind of hypothetical scenario, but it really depicts both the examples that we're trying to make the point. So that's good. And before you did the number breakdown, we thought what we think the average person would say, and that scenario, person A and B that you just kind of gave, kind of goes counter to that, which we didn't give our personal opinion, so now I'll give mine. I also think that on the average, right, because it's nuanced, that investing is the better option. But like I said, there's variables, some of which I want to talk about. And we had mentioned in previous conversations, like a big one is that you can't really quantify, just the pure emotional, mental satisfaction, peace, whatever you want to call it, that you get for not having a mortgage, right? Like, I'm not gonna lie, that's pretty nice knowing you can go to sleep and, hey, I don't have a mortgage, and that money that, because I don't have a mortgage, like, I can kind of recoup that, or that can go to the quality of life, or that can be invested. Like, that's pretty nice. You can't put a price on peace of mind. So just the first thing that pops in my head that goes counter to the person A would be the peace of mind. And that's if you're living in it. And if you have a real estate property that's paid off, like, now you're just cash flowing whatever you're bringing in on that again, you can do whatever, like even better. No more, you know what I mean? So I mean, the numbers are the numbers, and I agree with him. Because as many people said, also to quote Lil Wayne, like, numbers don't lie. Sure. But yeah, there's some things that do go in the favor of paying off the mortgage, like, and that's one of them. And I'm sure, we could think of some other things. I think age is a big piece as well. We kind of already talked about it and already hinted on it. Like, depending on what stage of life you're in, stage being that the age piece. If you're retired on a fixed income and you're just hacking away at this mortgage and you have an opportunity, I don't know, something happens, you come in some money or whatever, to kind of pay off or pay down that mortgage, that might be very advantageous because, as we know, the stock market is, we're speaking of the S&P 500, speaking to the 10% annually return over for the last X amount of years specifically, right? Like that's typically a long-term game. So yeah, if you're older as well, it may be advantageous just to pay down that mortgage and recoup that monthly payment so you can just spend on your everyday life, right?
Mhm.
Got it. Just things like that. I'm curious what other thoughts you have towards like, reasons reason paying down the mortgage might be beneficial. Another one just popped in my head, but yeah, what do you have to add to that?
So I'll start with I'll go into the age and emotional piece after, and then the et ceteras that I'm thinking about. But for the age, yeah, like I pretty much agree with you, right? Like at a certain point, you're gonna retire, most likely, unless you're the very select few that keeps working until you die. In that, if we assume, 65, whatever the retirement age you want to target, the closer you get to it, it just makes sense to shift your investment strategy towards just more of a guaranteed return basis for the preservation of your wealth rather than accumulating wealth. So, with that being said, when you pay down a loan at X amount of interest rate, you are effectively on a equal basis on the other side for investing. You're kind of getting the rate in guaranteed returns. So with the
Right.
10% average, that's an average. So some years could be negative 20%, while the next year could be 30%,
Positive, yeah.
right? So that kind of brings in the volatility and the uncertainty in your life that you may not want in your retirement years, right? Because like for me, I'm still working, I'm still in the accumulation of wealth phase. I don't, I mean, I think I'll be naive to say that I wouldn't care, but if stock market crashed 50, 70, 80% tomorrow, it's not going to change what I eat for breakfast
Yeah, long
tomorrow.
term.
It's not going to change my daily basis, right? Because I'm still buying. I know it's going to come back. It's going to keep growing. But if you're like ready to retire and stock market crashes by 80%, you might be screwed for the next 5 years. And that, I'm okay with the next 5 years, not, seeing a red on my portfolio. It's going to come back up, but maybe not for the retirement person, right? So this is more of a conversation depending on the interest rate you have on the home. But typically speaking, since paying down your mortgage is a guaranteed return of that percentage basis on your mortgage interest rate, the higher of the rate that you have, you guarantee yourself that guaranteed return of 5.5%, which it was an example
Right.
today, where
Right.
if you have a 2% mortgage like your buddy, that you're locking in a guaranteed 2% return, which is not
Yeah.
attractive at all. Like
Right.
you're losing to inflation at that point, right? So you're
Yeah.
kind of guaranteeing that loss by paying down a 2% loan mathematically. And then 5.5%, like I could see that being beneficial for certain people. Like, where interest rates came down a little bit. It's sounding like it's going to come down this year a couple more times, but at least for me in my high yield savings account, it was returning like 4.1, 4.2% in the beginning of the year. Now I'm at like
Now it's at
3.6%.
yeah.
But now you kind of got to think about it like by paying down this thing, you're getting a 5.5% return. So would you stick your money in a 5.5% guaranteed return? I wouldn't stick all of my money in there, but
But yeah, it's not
I would
bad. Yeah.
definitely be interested in that
Yep.
product.
Yep.
So that's the way off that you really have to look at your personal situation and your risk tolerance and where you are in relative to retirement. So I can't give an age for. I just can't give an age because it's like one of the
Sure.
variables.
Right.
But I would say, by the time you're like late 40s, maybe even like early 50s, probably the right thing to do is to start paying off your mortgage rather than invest. But if you're before that, it just makes mathematical sense to
Well
not do
said.
that, to stick it into the
Yes.
stock market. So that's the age
Yes.
thing.
And
On
on
the
that, real quick, just to
yeah,
further depict like what you're saying, which was better, which is the same thing I was saying, but just better, because we can't pick an age and like a rate because it's so variable.
Yes.
I think of so many things as like a sliding scale of spectrum. I think the older you get, I'm not gonna say you should, but the more it makes sense to consider the mortgage, similar to the interest rate. Like the higher your interest rate, because just like one of my coworkers has 2%. There's people with like even higher than like 7% interest. Like the higher the rate, I also feel like it's more comparable to the average return of the stock market. So like it also may make more sense to uh to maybe consider the mortgage. And then you combine them if you're older and a higher interest rate, you can start looking at that too. But yeah, I just that's how I think it in my mind. Like older shifts towards mortgage, higher interest rate shifts towards paying mortgage. But
Mhm.
again, these aren't absolutes and they're all things to consider. And then the offset of what you could get from the stock. Yeah.
Right.
That's all I want to say. Keep going.
Okay, so emotional piece is something, dude. I might ramble on the emotional piece. I'll try my best not to, but you got to understand, like me as a person, I just always been a math and science guy. It just the right or left side of the brain. I forgot which, but ever since I was in elementary school, I knew that I was better at math than majority of the people. And so
I've been the opposite.
early in my, I guess, investment career, right? If that's a super cliche thing to say, I get it. But I was completely 100% the numbers guy. And I started investing at 22 in stocks, like very dedicated, heavily into stocks. And then I'm 29 now. And I think in the last 6 years, I definitely had a change of thought. And the really key important word that I think I was missing, I want to say like I wasn't necessarily wrong at 22, but I would say I was more ignorant or naive of the overall big picture. Where now
Okay.
I'm not saying compared to others, I'm just comparing to my past self. I have more wisdom, like a more of an understanding of the bigger picture within the investment space. Does that make sense?
Yeah, 100%.
And the part that I kept missing was which is a very key important word in this conversation in personal finance, is the personal piece. Right? I don't know what it is. Maybe I just suck, but I just like it was like very hard for me to understand that others thought so differently on so many topics. I was just like, dude, the math says one thing. Like, how do we not agree on this? Like, it's math. Math doesn't lie, right? So that was the really big hurdle that I had to get over. But I kind of understand now where the capital difference in the scenario A and scenario B was 800K, right? And you really have to sit down and think how much your freedom, your mental clarity, and your freedom in life is worth. If you think it's less than 800K, it makes sense to invest the money. If you think you can sleep better at night knowing that you have no mortgage, and that piece of the equation that calculates your freedom number, right? If that's worth more than 800K, then it would be better just to pay off your mortgage. And that's the part that's very personalized to everyone. Because now I'm starting to realize the freedom and the mental, I don't know what the word is. I don't want to say mental clarity. That's not the right word. It's just like peace of mind. Yeah, peace of mind is probably the best.
Peace of mind. Yeah.
A peace of mind is just, I think I'm giving it more value than I used to. That was a shift that I had definitely in the last, I want to say 2 years. So the emotional piece, what I'm trying to get at is like how much you value yourself, and you really have to put a number to it, because I really do think some people would value their freedom less than 800K. Some people would value it more, and that number is going to differ obviously with the interest rate, the price of the home, but you get the idea. So I'm on the side of, I think if you're young and you're going to keep working, I feel like the right thing to do for the situation is to invest in stocks. But for your personalized situation, and you're like a really nervous guy, you just don't like debt, it's okay to like grow slower at a steady pace. Then I'm not going to be like, mathematically it doesn't make sense, but for your situation, it might make sense to pay off your mortgage.
Yes.
That's one thing. And one more thing I want to add is, because we're talking in averages, like this is a sad statement that I have to make, but I do believe this is very, very, very true in the American society, or I don't know, maybe in the world. I think majority of the people, I'm talking about 51% or higher, are not good with personal finances. It could be personal to everyone, but the strategy that they're employing is not good, i.e. getting into credit card loans, buying things that they shouldn't have bought. Going
Or
into
doesn't exist. Like some people don't have a strategy. Yeah.
Exactly, no strategy at all. Or you get into the gambling, and there's a lot of stuff that would add up to you not being good with your personal finance. The biggest challenge with that is knowing that you don't know how to manage your finances, if that makes sense. Like, that's the hardest part, I feel like, just the self-awareness piece. But if you can somehow get over that, and you're still at a point where like, dude, I just can't, I just suck with money. Like, even though mathematically it makes sense to recommend someone, hey, you should invest in stocks, as majority of Americans, if you suck at money, just pay down your mortgage. It's just a much simpler
simple,
way
safe,
to go about life.
Guaranteed,
and it sucks because I guess it goes into the topic of liquidity. Like, stocks is one of the most liquid assets in the world. As long as it's Monday through Friday.
That's a whole different conversation.
From 9:30 a.m. to 4 o'clock p.m. Eastern time, I can sell and buy a stock probably, like in less than a minute from unlocking your phone. Right? Real estate, so that's positive. It has pros and cons for that, because it's so easy to get in and out. Like, it kind of encourages trading, which we know that trading is not good for majority of the people. But also, like, it's much less stress knowing that you can offload something on a button click, right? Whereas real estate, like, you search for months to buy your property. And it might take at minimum a month. I mean, to close on a house is typically 30 days. So even if you get in contract minute 3 of your listing, you still have to wait a month, right? For you to liquidate your house. So that's not bad. I don't think it's not as bad as people depict it the way that they think, because it forces a behavior where it's hard to trade homes, right? So so you're kind of like forced to sit inside your house longer than maybe you like to, but that's okay for personal finance reasons. That the more, it just makes sense to hold on to an asset and let it keep growing. And that's the same idea with 401ks and retirement accounts. I hate that it's illiquid. I hate that I can't take it out. But for a lot of people, they have to like babysit you into holding your hand, like, hey, do not sell this thing. And that's majority of Americans' only shot at real wealth. So that's on the emotional piece.
There. Dang, that was good. You sounded like good stuff.
I don't know. So obviously you talked about it a little bit. You can go the hybrid method. I think it kind of makes sense to just go one or the other personally. But hybrid method, if both sides of the scale is good, hybrid is not a bad option either, right? Just to get that out of the way.
Yes.
And then, other basic personal finance strategy standpoint, the more diversity you have, it's better, right? Because for person B that pays off their mortgage first before they invest, they could be living in an area that real estate values in the area doesn't appreciate with the national average, or even less, below the market. And I mean, it also has the other side where, it could potentially get more than 5%, but that's typically on the more upscale areas, right? So like, imagine person B was living in Detroit in a nice, like they worked hard, they put 100K down on a nice property in Detroit, and then we all know what real estate prices are doing in Detroit right now, right? So that could be a risk. Whereas person A that invests into the market, if the same thing happens to their house, at least they have the stocks growing on the side at 10%, like
Yeah.
clockwork. So
Yeah.
diversity piece is like the first thing that comes up in my mind in terms of personal finance. And it's generally recommended you want to have as much diversity as possible. So all ups and downs of different sectors kind of equalize.
Right. Right.
Second thing, it's I wouldn't. I'm just mentioning it because we're talking about it on a podcast. I would probably not bring this up to a person if I was talking to them, but is like the minor piece of the equation is tax incentives. And for mortgages, if you have a mortgage, you have an increased chance of itemizing your taxes instead of taking the standard deduction. And if you itemize your taxes or itemize your deductions, then you can write off your mortgage interest, your property taxes, and your insurance against your active income. So you are just prolonging that recoupment of the the money services you have to pay for the loan, insurance, and
Yeah.
taxes for
Yeah.
state or county. I definitely wouldn't make a strategy based on the tax incentives for like
Right.
buying a single family home. Maybe some people's strategy going into like commercial like apartment complex could be for tax purposes, but for the everyday Americans, like what are we talking about? Like we were saving $3,000 a year. Like it's
Yeah.
just
So.
not anything to like go crazy about personally. So that's my thought on it. I guess both sides. Sorry, I was rambling for a little bit.
No, it was good. I was soaking it up. I was like, this is just all stuff we always talk about and we like to talk about. Yeah. And I feel no, like it's like you said, like neither is bad, right? And it's I guess which it gets redundant because I'm gonna say like your risk tolerance can come into play, but
Mm-hmm.
that also is usually kind of correlated with your age. There's other things, depending on what your 9 to 5 job is. Your day job like may afford you some more risk, or it's a lot of it's just personal preference. That's that personal piece of the finance. Like what literally, legitimately, what are you just comfortable doing? And that interest rate, what you paying down that mortgage or paying off, you getting back that percentage is, very guaranteed. But again, if you go on the S&P, like you said, that 10%, not guaranteed. The stock market is more volatile. Like that is a fact. But you look at the numbers, you look at history, that 10% is standing long enough. It's pretty likely it's going to average out. So it's like that also can be pretty stable on the long run.
Mm-hmm.
So it's very interesting. But I mean, hey, we did the number breakdown, so you can see, and to me, that's very hard to argue with. If you're truly in the middle, and that emotional piece, which you said so well, uh, is truly not a factor, and you're trying to maximize your dollar. I guess is the best way I could say it. I think I think the stock market is the more viable option more often than not.
Mm-hmm.
Which is the piece I think, we're ultimately rebelling because as we stated in the beginning, I think most people just hear the no debt, or, minimize debt. And it's like, that's like the catch right there. Like, it's like, oh, you jump at that, which again,
Yeah.
can't say it enough. Isn't bad, but it's like, if you are trying to maximize, it's not necessarily the best.
It's for the min maxers. We're really nitpicking here. I got some
We
couple
are.
I got
I'm
some
about to say min,
couple
I've never heard
comments I
that
want
term.
to make. One's on
Yes.
the
Okay.
hybrid approach. And
Okay.
I have heard this multiple times on shorts and stuff. And I said, I literally just said, if you're going to do the hybrid, just go one for the other. But this is one hybrid strategy that I saw a few times online. And I was like, I could get behind this one. So let me explain. So mortgages are typically, maybe it's the first of the month or 15th. It doesn't matter the date, but it's typically once a month, right? For 30 years. So in a year time frame, you're making 12 mortgage payments.
Right.
I have heard of a strategy that's hybrid. I guess not necessarily hybrid, but like paying off your loan faster aside. That says instead of making one monthly payment, make a payment
Was a
every 2
buy.
weeks.
I guess, dude. I
Yes.
heard that too.
And then at first you're like, what's the difference of making a payment once a month for a year, which is 12 versus 2
Yeah.
weeks? And 2 weeks would be like like the monthly mortgage amount, you would divide it by 2 and make that half of the payment the first 2 weeks and the second week, right? So and you're like, oh, it's the same thing. It's not, because you have 12 months in a year, but you have 52 weeks in a year as well. So 52 divided by 2 for the bi-weekly payments is 26, right? So if you make that into months, you divide that 2
Yeah.
again. So that's 13 payments that you would be making in the course of a year, which is one extra payment than what you would otherwise made. And the 2 weeks thing makes sense to me, the bi-weekly portion, because it typically, for a lot of the people, aligns with their paycheck
paid.
schedule,
Yep.
right?
Yep,
So it's much easier to manage. And by making one extra payment for the year, essentially, you do get to pay off your mortgage 4.5 years earlier if you did that. So I don't think that's
significant, yeah.
necessarily. I don't think people. So I get paid. So I was in the Navy before, which you get paid bi-monthly. Wait, yeah,
Yep.
twice a month. No, so you got
No,
not
that was
bi-month. Sorry, first and the 15th, I got paid in government, right? But now I get paid bi-weekly, so not the first and the 15th, but every 2 weeks on a Friday.
Yeah.
So that is a difference between 24 payments and 26 payments. But this, according to how much you make in total, so how much you effectively get into your pockets is still the same. But I don't, for the people that's on the 26 biweekly payment like pay schedule, at least for me, that typically lands around like you get one extra payment in like May or June, and you get one extra payment in like November or December type thing. But I don't think people are expecting or counting on that extra payment for the monthly budget that they live in, right? Like I certainly don't. I see it more of a bonus. Like, oh yeah, I guess I am getting one extra paycheck this month. So with that extra money, I think it's like mentally, emotionally, it's much easier to apply extra into the mortgage rather than like trying to adjust your budget on a monthly basis to accommodate for the extra payment. So that's why I like that, pay half of your mortgage bi-weekly, which ends up being 13 payments out of the year versus the 12. So that's on the hybrid piece. So this second one is just how I view money. And I think it would be beneficial for definitely for the episode, but as like a platform in general, as like being a rebel in how people think about stuff.
Okay.
I am very, very, I'm not saying right or wrong, confident in the sense that I'm right or wrong, but I'm very, what's the word? I'm very closed-minded into the thing that I'm about to say because I thought about it so long. I came to a conclusion. I don't think I'm going to change the conclusion until I die. And the idea if you're into money, like it's like, oh yeah, this is obvious, but a lot of people are not into money, right? So the idea is topic around inflation, and inflation happens when there's too much like money printing that happens, and your purchasing power just goes up over time. And it's not a bad thing, and I think everyone's heard it on news recently in the last couple of years. Inflation was crazy high. It's still hovering around 3%. The Fed wants to get it down to 2, whatever, right? But you got to think like where when you are investing in the stock market, inflation is kind of working for you and against you at the same time, because inflation everything kind of rises. Like if you pay $1,000 for an iPhone, because of inflation next year, maybe you pay 1,100. So in terms of stock growth, like your stock value of the company that you're investing in will go up regardless of if they do better or not. Let's say they stay stagnant, the value should go up based on the money being devalued, right?
Right.
So that's a good thing for stocks, but also the bad thing is the money that you gain in a stock is also like worth less, right? Because of inflation. So it's kind of new, I guess. Good and a bad equals out to be a neutral and real for stocks, right?
Okay.
But you are still investing in an appreciating asset. That's the takeaway from the stock side. That's very important in this conversation. You are investing in appreciating asset. On the other hand, when you have a mortgage or a loan, inflation only works for you. It's a good thing to have inflation if you have a mortgage. And let me explain why, right? Let's draw out a scenario where you take $1 million in debt in the form of a mortgage, let's just say, right? You're like, whoa, like $1 million, like nice property. It's a lot of money. But there could be a scenario, and this is so exaggerated, I don't think it's going to happen. I'm just trying to prove a point.
Yeah.
Where the United States dollar could face a similar scenario, similar trajectory on how like the Zimbabwe dollar like faced, which they faced hyperinflation, which means their dollar kept getting devalued like crazy.
Yeah.
So almost everyone in Zimbabwe is like a billionaire. Like kids are millionaires, right? But the $1 million is not really worth much in their currency. But so kind of think about it from that perspective for your $1 million mortgage. If you get a $1 million mortgage today, in the next month, like the dollar gets devalued by 50%, you could naturally expect your stock portfolio to do well, your income to rise, because just for the same services, the dollar's devalued. So everyone should like go up in purchasing power, right? But your loan stayed at $1 million. So essentially, your loan got devalued because of inflation. So you're paying back $1 million, still the same numerical value, but in terms of the value provided by the $1 million, you're paying much, much, much less. So that's an extreme example, but still the top like idea stands. Like you're holding a mortgage for 30 years. Like think about. I'm not going to even think about it. I'll give you the answer, right? So, I'll say national real estate single family house price 30 years ago. The median sales price for homes, including single family, was $114,000. Right? So basically $115K. I know it's not apples to apples, but just bear with me in the argument, okay? Just imagine 30 years ago, the $115K that they had to pay for a house is what we feel today for paying a $400K house. Let's just say, right?
Yeah, right.
But as time passed, I know you're paying off the loan, but let's say you didn't, right? But you are paying down $115K in today's money, which if someone was paying $115K for a house in today's money, they're like, dude, that's a freaking steal. Depending on the house.
Yeah. Let's be right. But more than likely, it's a steal.
So it's the same thing for what we pay today in the $400K. Like, I believe naturally real estate will appreciate without inflation, I believe, based on supply and demand, because our population is growing. and the house building is not keeping up with the demand. So I think from a supply and demand standpoint, prices will go up. Second is, regardless of supply and demand, I do think it's going to go up in prices regardless because of inflation. And usually real estate prices have what's called an alpha. Alpha is like how much you beat something by. Like for alpha for a stock market could be like how much you beat the S&P 500 by.
S&P, yeah.
Right? So if you got 15% return and S&P 500 had a 10% return, you had an alpha of 5%, right? That makes sense. So real estate usually has an alpha of 1 to 2% above the inflation rate, which if inflation rate is 3%, real estate will generally appreciate 4 to 5% on an average basis.
Right.
And obviously, like it's not doing that today. Like obviously, like it's not a perfect math. Like during COVID times, we saw appreciation like
average,
crazy.
Yeah.
So that's kind of taking away the appreciation from future years. But inflation, basically, the summary of that is for stocks, inflation is neutral. But for the real estate case, or for like any like loan involving investments, like inflation is good. Inflation is working for you. So that's one of the reasons why I don't, like, from a fundamental, like a big picture strategy standpoint, I'm not fan of paying down a loan that you have secured for 30 years straight with
And it's
no
locked
changes.
in. Yeah.
Like it is a crazy thought. Like if I went to you, it was like, yo, Julian, let me get a 30-year loan for 5%. Yeah. I know you like me and we hang out a lot, but I don't think you would say yes to that. And nor would I. Like it's just a
how much?
Depends on,
But right,
it's not a smart move financially speaking.
Sure, right. Yeah.
Like you're collecting 5% premium on inflation that's running 3%, so your real alpha in this case is 2%. Like who would do that, right? Maybe depending on if you're older, you're just looking for income, whatever, right? But
right,
not a lot of people would do that. But
again, on the average,
we have a country, we have a government where they back this stuff up. They're like, yeah, like owning a home is the American dream. And we'll give you this crazy loan product that you don't really see in other places, right? Like go to Canada. Like you don't have, it's much rare to find a fixed income or fixed interest rate loan for 30 years. So because of that reason, and what I was talking about with inflation, like owning a loan at a low interest, like it works all in your favor. That's why I'm behind the argument of, if you can afford a home, I think you should. It's as long as America just keeps thriving, like I think you're going to do well as well.
Dude, I'm so glad you brought inflation into this because, I mean, honestly, I think that's a good point. And that's, I think a little bit, maybe like one layer deeper into the financial literacy piece. I mean, I couldn't even articulate all of that, what you just said, that well, but when you break it down like that, it just makes sense. It's just the numbers. And it's not something you can ignore. I mean, you can ignore it, but it's good to hear it even if you don't understand. So you know what your essentially loss is. Like you're taking a loss on your dollar if you're not, accounting for all these things. You can't account for everything. But no, I think that's money, dude. No pun intended. But yeah,
that is literally that's real money.
That's
yeah.
money.
I do think like you just said, it's not bad in both cases, but not thinking about these kind of stuff, you're gonna pay for it somehow. You might pay for it in terms of, you might not make as much as financial gain, or you might not have a more of a peace of mind than otherwise you could have. So you're paying, not knowing these stuff, like you're gonna pay in some form of something, not necessarily money
Right. So
related.
yeah, money.
But
Right.
that's why I think it's good to know these macroeconomics, just ideas and like big picture personal finance stuff.
I love it. And I don't know. I think that's kind of what makes personal finance so cool. And it's not, it's very much not a one size fits all. But uh, the numbers are the numbers. So we talk about. We've had a couple episodes where we mentioned medicine or like the health, right? And it's not one thing doesn't work for everybody. But in the finance space, the personal finance, I very much agree that it's not one size fits all. But in certain cases, like in all cases, inflation hits everybody the same. Like an interest rate is the interest rate. Like the economic effects are the same. It that part of it is standard and it is objective. So yeah, it's just things to consider. Now, what you weight personally is, that can differ. Different people have kids or don't, or might be saving or something where others aren't, or might be younger. So right, well, and we get that. That's acknowledged. But um, yeah, this is such a good topic, and it excludes people that sure don't have a property. You might be thinking like, oh, like, this conversation isn't for me, but it's still like you might one day. And as B said, even if, and I really want to like drive this point home because I got to a point a couple years ago where I felt like maybe just being fortunate enough to be in these spaces, but like I feel like a lot of people around me were just getting into real estate, whether they were becoming realtors or like buying personal properties, just trying to buy their first house or invest, to the point where me and some of my friends, I think like, are we behind, or like, do you have to buy property? And the answer is no, right? You absolutely don't have to buy property. But to your point, you don't have to want to be a realtor, or it's it's just a good asset, I think, that you know is gonna appreciate. Like you said, provided America is I guess continues to thrive. But more or less, is going you can get an appreciating asset. You don't have to be trying to flip houses, or you can, it can be something passive. Like there's so many ways to go about it. To agree with you, I think it's just a smart investment if you're able to do it. Like get your foot in the door somehow. Uh, that would be my recommendation.
Mm.
You know what I mean? Like, yeah. And then to kind of try to bring it full circle, you're gonna have to help me with articulating this. But the difference of, even if you did a hybrid, or comparing the difference of your assets, or I guess maybe even different asset classes, like if you, how do I articulate this? I'm trying to get it as like arbitrage, right? Like, isn't that like, is it the difference in the sum of your assets, right? Like if you have something that has a net profit of 4% here, but
Oh,
this is,
is this for real estate or right? Real estate, right?
I, I mean, sure, but can't you apply it to,
You can.
is it,
It's
is
much
it,
harder
yeah,
to.
I'm just trying to think of more generally.
It's
Maybe that's
much
not the right
harder to
terms.
apply on a stock level, but at
So,
least for real estate,
okay.
what I think you're trying to say, I could be totally off, but when you say arbitrage, what I'm thinking about is you're borrowing at 5.5% rate, let's just say, right?
Yep. Right.
And this gets a little bit more nuanced in real estate, depending on how much you put down. But let's say you put $0 down, and there's a lot of loan products out there, and I have done it for the VA loan product. But
Yeah.
even if you're
Yep.
not in the military, you can still do 0% down. But regardless, let's say you put 0% down on a 500K property, let's just say, and your interest rate's at 5%, right?
Yep. Easy math. Let's do some easy math.
So
Yeah.
while you are paying 5%, if the house is getting appreciated by 5%, then like you're not really losing anything, right?
Right.
Like your house is appreciating. But if you put down, let's say 100K down, right?
Yeah.
You you are paying 500K, or you're paying 5% on your loan, which is, let's say, 400K in this, right?
Uh-huh.
But if your property grows at 5%, your property doesn't grow based on the amount of loan you have. It doesn't matter. So if the house is
Right.
getting appreciated by 5% on a 500K property, that's more growth than the 5% that you're losing to the interest rate for your 400K loan.
Or your 400.
Does
Yes.
that make sense? Yeah, that's the arbitrage piece
Yes,
that
and
also
yes.
fuels real estate, but I think that's more of a topic between stock versus real estate, and that one's so
Yeah.
nuanced too. But yeah, is that what you're trying to?
Yeah, and I guess I was trying to. No, that is the concept.
Okay.
Like, yeah, like you said, the same percentage, but on a different amount. Like it could be different. I guess I was trying to extrapolate that to more outside of real estate.
You could
But
do it. You could do it with stocks,
yeah.
but like
So I was like, I don't know if that's the right word, but yeah, that's basically the concept.
yeah, like you would be taking out a margin loan in your brokerage to buy something, and it would work. It would work if your conviction, your thesis is correct. If the stock rallies 50% and your margin loan was 6% to hold it a year, then from that transaction alone, you benefited 44%. You arbitraged 44% in your favor, but same idea, but just harder to execute on a stock side versus real estate because
okay,
like a
yeah,
short term level is almost like speculation. Like stock chart could look like this,
could
really healthy growth over time, but if you zoom into like a daily chart, it could go up and down, up and down, up and down.
Yeah.
So it's not as popular for the arbitrage in the stock space, but without you knowing it, a lot of people already do that on the real estate side.
Yeah. Thank you for help. That's why I was like, for helping me articulate that. And I love it. And I think we articulated the point pretty well, just to highlight, both sides, right? But the advantages and maybe why, on average, we would lean towards stocks in general. But again, you just can't discount all the other things that, for an individual may make you lean one way or the other. But I'm not going to rehash that because I think that was very well stated. You give the number breakdown, which was phenomenal. And, I hope this just helps people think about things differently. Maybe it encourages somebody to look into stocks a little bit more, maybe peel back the real estate onion a little bit. And we always encourage us to kind of do like the self-research because I think that's where like the learning really happens. But it's awesome that, to provide a platform where these conversations flow. So that's always exciting for me. Dope. Another little Jew and B take on a snippet of the finance space. So join us next week for a fresh topic. That's all we got for today. Thanks for joining as always.